Guy, are you ready?
I am.
All right. Then welcome everyone. Hope you're having a nice evening and a good start to the year. And we are excited that you're joining our very first meetup for of Women Tech Makers for 2025. And hope this motivates you to do some New Year's resolutions. So questions, policy, and introduction and everything. So I will say at his part, I'll just say that we are here since 2015 and doing all sorts of meetups online and in person on all sorts of topics of tech, and then what to do with all that money that you're earning. Have fun. Hagai, handing over to you.
Thank you. All right. So, hi, good evening, hello. Also from my side, belated Happy New Year. I'm very happy to be here again. It's been a while. I think it's been 4 or 5 years. So, many thanks to Natalie who invited me to drop in once more. Probably a lot has changed. A little bit in the world has changed. A little bit on my side. Probably the audience here is also already a little bit different, if not completely. Um, so I'll start maybe with a quick intro, just real short, a little bit about myself, and then a little bit about today's session. First of all, real quick about myself. Somewhere back in the day, I got a bachelor's in business and have been active in various functions throughout the years. I'm a founder of 5 companies to date, one back in Tel Aviv, the remaining 4 here in Berlin. Um, I've been personally investing in the stock market and in other investment products for over 20 years, probably now. And today I am operating as an independent consultant. Um, in the context of investing, it's probably worth mentioning, I have, for better or worse, personally probably made almost every possible mistake. And through those mistakes, I've learned some very valuable lessons. Some of them were expensive lessons, but still very valuable. Um, and through this process of a lot of learning, a little bit of very basic trial and error in the beginning, and later really learning by doing and a lot of research, um, I was able to really formulate and create a strategy that works for me, and I think suits pretty much 99% of all living people. Um, and this is what we will mainly focus on today in a very short and boiled down version. Um, and my main motivation for doing that and how I got to a point where this is quite a significant part of my day to day is that over the years, the deeper I got and the more lessons I've learned and gathered, the more I noticed around me a lot of people that are actually very, very smart, very capable, very successful in their personal lives and in their careers, but still have that fear or maybe even a mental block regarding everything that has to do with finance and investing. Um, Probably because more than anything else, this whole field seems quite complex, I think, when you're looking at it from the outside. Before you make those first few steps, it can be quite daunting. And it's something that I've experienced, I think, firsthand, first of all, here, I mean, at home with my partner. And from there, I've expanded the circles in which I try to, first of all, have a conversation with friends, colleagues, family members, and so on. Um, and I really saw that there's a lot of misconceptions, perhaps, an overload of information, even these days. And what I try to do, and what I consider to be really my main mission, is to really simplify, demystify, and create a very simple plan, which pretty much anyone can follow, but to support that with the basic knowledge that is needed to really know why am I doing what I'm doing now? Why is that my plan? And how can I trust this to work for me in the long term? So more about that as we dive in. A quick disclaimer about today's session, and in general, I am neither an investment consultant in the formal way or in the formal definition, nor am I a tax consultant. So everything that I will be sharing with you today is based on my own personal experience, my own personal research, and the work I've been doing in the past. A more general disclaimer, perhaps, which is always crucial to mention, when it comes to investments in any way, shape, or form, past performance doesn't guarantee future results. We can only look back and analyze and create statistics and try to learn from that and draw conclusions on that. But obviously, we don't know what the future holds. Regarding today's session, it's generally planned for 2 hours, whereas my presentation hopefully will not take longer than 1.5 hours. That depends, of course, on how fast we go through it. And that depends mainly on the amount of questions. I do, however, strongly encourage you to ask whatever question you want at any point. So you don't have to wait for me to get to the end. On a technical note, I have the chat open. I'll do my best to pay attention to that and see if any questions were added. Please also use gestures for that. Raise your hand virtually. And I hope maybe Natalie can here and there also support me on that and see if any unanswered questions were left.
Absolutely.
And beyond the technical aspect, I know it sounds a little bit like a cliche, but I really do mean it. Please ask whatever is unclear to you. I'm not assuming any prior knowledge. And really, at least for the duration of our session today, there are no stupid questions. So please feel free and make yourself comfortable to ask whatever is unclear in whatever is in the presentation, or if it brings anything else to mind that you've come across, that you've heard, that you've read, and somehow doesn't make sense to you and has some connection to what we're talking about. All right, and with all of that said, without further ado, let's get started. Okay, in the very first part of the presentation, I'll focus on the reasons to invest. To kick that off, we'll use as an example a Jane Doe. For the sake of our discussion, we'll assume that Jane is 35 years old. She has been working already for 5 years here in Germany. And at the moment, she's making a gross salary of 80,000 euros per year. Jane is not completely uneducated when it comes to finance, and she definitely manages her personal finances. And she does so by following a rule which some of you might have come across already in the past. Maybe some of you are even using personally, which is the 50-30-20 rule. And what that means is that 50% of her net income goes to her very basic needs. That would be rent, grocery shopping, healthcare, etc. 30% on top of that would go to her wants, the stuff that she wants to do. She doesn't have to, but she wants to. That would be hobbies, vacations, any free time activities, etc. But she does keep an eye on her personal budget, and she saves 20% of her net income as savings for the long term. Now, for her retirement, at the moment, Jane purely relies on the state pension scheme here in Germany. I think from a first look here, if you only had this information, at a first glance, probably most of us would say, A, she probably has a good position. It's quite a nice salary to earn. And B, she's also really managing her finances in a good way. So not everybody follows this rule, and to be saving on a regular basis 20% of your net income is absolutely not bad at all. So we do have a very positive starting point. Now let's have a look at Jane's status quo but also her forecasted status when she will be on the verge of retirement. As of today, as we mentioned, she has a brutto salary, a gross salary of 80K per year. And of that, what is left as net salary is almost 48,000 euros per year. And since we mentioned that she follows the 50-30-20 rule, she saves 20% of that and 80% she spends on a regular basis. That includes the 50% needs and the 30% wants. Now, if we extrapolate that and we try to focus what would be her situation on the eve of retiring. So when she is 66 years and 364 days old, for the sake of the example. And what I did in this case was to assume that her salary would increase at the same rate that salaries in Germany have increased over the past few decades. And that amounts to 2.85% in our case, which would bring Jane to a total gross salary of 191,000 and a little bit more euros per year. And again, we can see what her net salary would be after taxes and social security, etc. And of that, she is still maintaining her 50-30-20 rule, and she spends just over 90,000 euros per year. Now, that is on the eve of her retirement. What happens when she does reach retirement age and she doesn't work anymore, she doesn't have a salary anymore, she starts getting the state pension allowance. Those are very, very, very real numbers. So based on the example here on the duration in which Jane has worked and made contribution towards her pension allowance, her future pension allowance, and based on the current system and how it currently works in Germany, those are very, very, very realistic numbers. As concerning as this may seem, and you see a very, very, very significant drop in her overall level of income. Her brutto drops, her gross salary, or her gross income in this case, drops to less than 60K per year, and her netto is almost 33,000 euros per year. Now, if Jane wanted or hoped or planned to maintain her level of spending, which we earlier mentioned was quite reasonable in comparison to her level of income, you can see here that that would be completely impossible. And not just that, she's not even close. The gap, so to speak, is immense. And I think it's important to mention not just the gap in terms of absolute numbers, but also you can see that her net income doesn't even reach half of her level of spending. And we mentioned earlier that 50% of her spending is really her needs, not even her wants, not even her hobbies, free time, vacations, etc. It's really her basic needs. It's her very, very necessary parts of her spending, like rent or mortgage or whatever that may be in her individual situation. It's groceries, it's healthcare. It's the absolute must. And you can see that the gap here is really, really, really significant and unimaginable. And you can imagine that if it were to play out in exactly the way it is shown here, she would have a very big problem. Even if we look at a more optimistic scenario in which the state pension allowance is adjusted upwards at a slightly faster rate than in the previous example. In specific terms, instead of adjusting it by 2% per year, it will now be adjusted by 3% per year, which is exactly how the state pension allowance is managed currently in Germany by those annual adjustments. In this case, which is obviously better, the gap is slightly smaller, obviously. However, it's still very, very big, and it's still very, very considerable, and it's still below this very, very bare minimum of 50% of her spending level, which means if she doesn't find another source of income, she would have to cut off significantly many things that she's spending money on. And in other words, she will have to drastically reduce her standard of living and her quality of living. Now, those numbers are not just made up numbers, they are, again, very, very realistic. Um, in terms of the adjustments to the pension allowance, since 2000, so in the last 24, almost 25 years, the adjustments have been at an average annual rate of less than 2%, actually 1.89%. So the scenario with 2% is not over pessimistic. In recent years, it has been slightly higher, 3% and even above. However, I think what is important to mention is that this is a decision that has to be made actively by the people managing this system on an annual basis. There is no fixed mechanism that increases this rate based on whatever index, not the consumer price index, not the average salaries, nothing like that. It's a decision. And unfortunately, and sorry to be pessimistic here, we do know how governments behave when they don't have enough money and when things are a little bit more tight. They try to squeeze the budget and to avoid any unnecessary increases in spending. And so the conclusion here is that this is absolutely not enough. However, some of you might be thinking back about the basic details that we showed about Jane, and some of you might be thinking, okay, what about her spending? As we said, she was quite well managed over those years, and she always saved quite a significant amount of her income. So that adds up to something, right? And if she maintained her policy over those years, and it's over 30 years, but for the sake of the example, let's assume that she did, she would have saved up almost €500,000, which is by all means a considerable amount. So we have a solution, partially. However, probably it's also obvious to you that that's probably not enough. If she just tries to make up for the difference, for the missing income, by using up those savings gradually, if she really wanted to maintain her standard of living, that would be enough for it, not even 10 years. And then all her savings are eaten up, there is nothing left, and she is again fully dependent on the state pension. And so again, we are faced with the same question. How do we bridge the gap between her level of income on the day before retiring and what happens after, when she depends on the state pension? Now, one alternative, if she is aware of those numbers already now, she can decide to try and work harder and to make more money. I personally don't think that's a very good strategy. We have to assume that having such a good salary probably means that she has a good position and she is probably maximizing her potential in terms of employment and income. Now, it's quite unrealistic for more people to work more, to find more time to take on another job or other projects or anything like that. At the end of the day, we do only have 24 hours in a given day. And for many people, that is really technically impossible because they have other commitments, they have family, kids, whatever. Another alternative is to decrease spending, to move away from the 50-30-20 rule to something even more conservative and to save even more money. However, that's also not a very, very good alternative, in my opinion, because it means already now decreasing her standard of living. It means giving up on some of her hobbies, free time activities, etc. And I am also a very big believer that life is now, and there's only so much of the present that we should be willing to sacrifice for the sake of a better future. And of course, it's important to find the right balance, but I think if you are already someone who is closely monitoring their finances and following the 50-30-20 rule, to decrease your spending even more and to save even more probably means that you're giving up on quite a lot. And so, from my position and from my point of view, The best alternative is to find a way to use her money to generate more money, because that's the resource that she can use and that she can put to work in order to really make a difference over those 3 decades or even longer, so that she can put herself in a much better position when she reaches finally retirement age. And obviously the question is how? How would you do that? And the answer I would like to suggest is we do that by investing passively for the long term in the stock market. And each and every one of the parts of this long sentence is very, very important. And with that, I would like to dive in and start walking you through what I think is a very important part of the personal finance or the financial plan for each and every one of us. We start with the benefits of long-term investing and why is it so interesting and why do I focus basically strictly on that. Einstein himself said that compound interest is the eighth wonder of the world. Some of you might have heard this quote directly, and even those who haven't, probably some of you are already familiar with the concept of compound interest. Still, I would like to give what for some of you might be a good refresher, and for the others, hopefully a very good introduction to the concept. For the sake of the example, let's assume that I have an investment that yields 10% every year. Very simple. And the amount that I have available to invest, 1,000 euros. And so if I start with 1,000 euros and I invest them in this investment opportunity, regardless of what it might be for now, by the end of the first year, I will have 1,100 euros. And the profit, unrealized profit that I have for now is the 100 euros. And those are quite easy numbers to work with, and I think probably most of us can calculate that in our heads, and it's quite easy to see. Now, what I do at this point is I let it keep on running. I do not take out the profits. And so my starting point is now 1,100. And by the end of the second year, I will have 1,210. And you can see that the profit is similar but slightly higher. It's no longer 100, it's now 110. So it's the same 10% that we see. And the same happens if I just keep on letting this investment work and accumulate profit and return. And now the profit by the end of the third year is again slightly higher. And the same works over time, and you can see how the numbers increase gradually. But the longer we let this process keep on working for us, the bigger the difference will be. And it is always the same 10%, but the absolute number and the absolute profit from year to year increases, and quite significantly, because in the first year we only made on paper 100 euros, but from the end of the 9th year to the 10th, we made more than double that amount, and we never had to change anything. We never had to take any further action. We didn't deposit any further funds into this investment. We just let it be. We just leave it. And that is exactly the beauty and that is the power of this concept of compound interest. And I think in simple words, what it means is you leave it for as long as you can. You do not interrupt the process for as long as you can. And you plan for a long as possible investment period. Now, another cool thing about compound interest, specifically at a rate of 10%, and this is something I think worth remembering as a rule of thumb, you can see that from the starting point, after just over 7 years, we already doubled the initial amount. So by the end of the 7th year, we almost reached 2,000, which is double. And then slightly afterwards, we will already double our initial investment. And so the rule of thumb is that if we're looking at something that yields 10% on average, we can assume that every 7 years we will double our investment. And then if we look at the same concept over a longer period of time, you can see something that I think is even more interesting, because those are exactly the same numbers up until the 10th year, as you can see. But if we really look at a longer period, and by that we are also zooming out, you can also see that the shape of the chart really becomes interesting. It's almost exponential growth. And the only reason for that is we leave it, we let it run for longer. And then if we look back at the same rule of thumb, after slightly longer than 7 years, we doubled our investment for the first time. Now we have double the original amount that we've invested. Again, after another 7 years, we doubled it again. So times 2 became now times 4. And after another 7 years, we're already at 8 times the original amount we've invested. And you can see and you can imagine that if your investment horizon is even longer than that, how strong this effect of compound interest will be. Because by the 29th year, it would be 16 times the original amount, and so on and so forth. And the longer you have, the stronger this effect will be, and the stronger the effect will be visible. And at the end, the only thing we as investors need to do, as I said before, just don't interrupt. Don't be tempted to have a look at it, get impressed, and then take out some profits, because you're weakening the effect. You're weakening how strong this thing can be for you. And the longer you wait and the longer you have to wait, the better it is. And with this concept of compound interest and effectively long-term investment, we move on to the next part, which is really what to invest in and what sort of investments could offer us this benefit exactly, the benefit of compound interest over time. And as I mentioned already before, in my book, the answer is stocks. Why stocks? The short version is that this is a comparison of the returns that stocks generated versus bonds versus gold as a representation of commodities in general. And I think it doesn't take a very deep look to see that the difference is just immense. Those are stocks, if that was not clear. And you can see here at the bottom, we have, in this case, corporate bonds, and then here, even lower, if you can even see it, those would be treasury bonds, so basically government bonds, in this case the US, but it's a general representation, and gold, as I mentioned, as a representation of commodities in general. And so the conclusion from that is that over time, nothing really beats stocks. Now, there are a few other reasons why I do believe that stocks are the best place to start. And specifically, those would be that there is no minimum amount to start. Unlike, for example, investing in real estate, there is no minimum amount of capital that you need to even get in on the action and really participate. You can start with literally any amount, even just a few euros. The second thing is that if you do it right, and we'll talk a little bit more in detail what right means, in my opinion, the amount of effort that is required is really close to zero. And once you have your plan laid out and you know what you would like to do, you can fully automate it to a point where you literally just don't do anything, really, really anything. And the third point is liquidity. On the one hand, I am a strong advocate of long-term investing and really, really, really basically kissing your money goodbye when you invest it into stocks and hoping to meet it again in 20, 30, 40 years, not before that. However, life is life. Life can be sometimes unexpected. And when it comes to stock investing, you remain liquid. You might not have access to all of your investments at any given moment. You might not want to sell at a specific point due to fluctuations and changes, etc. But he will almost always, almost certainly, will have access to at least a certain amount. And if something really, really drastic and unexpected happens in your life, that's another big benefit. Again, for example, in comparison to other investments like real estate, where if you really need to liquidate your investment fast, that might be difficult, and there will be a price to it because you will probably lose at least a little bit, if not more than that, of the value of your investment. And so we move on to the next part, which is if you are already convinced that you need to invest and that stocks will give you in the long term the best possible returns, why do I believe that it's best for all of us to just put it on autopilot? There are two main reasons for that. The first one is we want our money to work for us and not the other way around. Meaning, in simple words, we all have better things to do. We all have our day jobs, we all have our other commitments, and we are not looking to make more effort, but exactly the other way around. We would like to keep it simple and to invest as little amount of energy and time as possible. The second reason why I think putting your investments on autopilot is best is, in my opinion, even much more interesting. Because when it comes to stock investing, the bad and the good news is that nobody knows anything. The guy in the picture is called William Goldman. I guess you got that. And he has very little to do, if at all, with investments or even finances at all. Goldman was actually a screenwriter in Hollywood quite a few years ago, and he coined that term. And his original meaning was that in Hollywood, nobody knows anything, meaning nobody knows what might turn out to be a success. If you come across an idea for a TV show, a movie, a screenplay, whatever, everybody has an opinion, but at the end of the day, nobody knows anything. And it's extremely unpredictable. Now, someone who adopted this quote has much more to do with finances and investments, and this is Mark Randolph. He's one of the co-founders of Netflix. And he mentioned more than just once that his favorite saying is nobody knows anything, which he in turn applies to the world of investing. He's obviously very active and he's doing a lot of investments directly into startups and into companies. And he talks a lot about the topic, but he adopted and adjusted this saying to match it to the world of investing, really by saying it is so complex, it is so unpredictable that nobody knows anything. And to try and predict what will work, what will be a success, is futile. There's really no point. Now, at this point, some of you might be thinking, fine, it's a nice concept, but some people probably do know something about it, right? It's basically their job to know. It's what they do. They get a lot of money for it. They have fund managers and analysts and anyone who has anything to do with finances, and their job is to predict what will be a success and what won't, and basically where to invest, where to put their money and other people's money. And the reality, surprisingly, or maybe not surprisingly for some of you, is quite different. In 2022, a reporter for the New York Times looked at the performance of over 2,000 mutual funds over the period of the previous 5 years. And just to explain a little bit further, maybe, mutual funds, those are the funds that are managed by and sold by banks. And usually what that means is that there is a fund manager, there's a person who is in charge and decides what to invest in, which companies to invest in, what bonds to buy, etc. Obviously with the goal to generate the highest possible return for the investors. However, when they looked at those more than 2,000 mutual funds, not one of them consistently delivered better performance than the overall market. Now, this was 2022, but the interesting part is that in 2015, the same guy, still for, or already then for the New York Times, did exactly the same thing. And the result was exactly the same. None of them were able to beat the overall market performance. 2014, even earlier, same conclusion. From a different angle, a very similar research, this time a little bit more academic, uh, now made by a person called Aswad Damodaran. He's a professor for finances in NYU. And by the way, if you're maybe familiar with the name or if you hear it now for the first time, definitely one of my all-time favorites in how down to earth he is, how clearly he can explain complex concepts um, without being too bombastic, without overcomplicating, and with really focusing his research on things that are, I think, very interesting, such as this one. But the idea was the same. The idea was to compare actively managed funds, where there's a person who decides what to invest in, against passive managed funds, or basically indexes, or the market as a whole. And his conclusions were exactly the same. Over time, nobody can beat the market, and no one can deliver better results than the overall market. And he also added another point, which sounds trivial, but actually is very important. Those actively managed funds are also very expensive as a product. They typically charge between 1 and 2% every year of your investment amount just to manage your investments. And what that means is that they have to beat the market by at least that amount, so by at least those 1 to 2%, in order to break even, in order to be a comparable alternative. Because if they don't, then you're definitely much worse off. Because even if they deliver lower performances, then they charge the management fee on top, and you're even worse off. And lastly, which I think is also very important, even those who occasionally beat the market and on a specific year do deliver much better performances, do not do it over time. And when he really dives deeper into this point, what he basically says is that that is actually also very predictable because they beat the market, so to speak, and they deliver this superior performance by taking higher risks. And if they are lucky, the risks do not materialize in a specific year, and they do enjoy the better performance. However, at some point, the risks will materialize, and then they will probably have much lower performance, probably even negative. And so, even those who occasionally do, and the ones who were ranked in the highest places on a given year, will be at a much worse position in the following years. And the question is, okay, but what do we as private investors, as even, let's say, small investors, what can we do about it? How do we go around that? Enter Jack Bogle, the guy who somewhere in the previous century said, don't look for the needle in the haystack, just buy the whole haystack. In other words, what he says, it's impossible to pick the winners. It's impossible to predict who or which companies will be the biggest success stories, which I think goes back exactly to the concept of nobody knows anything. And what he says basically, since you do not know, just buy the whole package. And as is usually referred to in the finance world, buy the market. If you remember the first example with the 10% per year, it's now coming back because when we're looking at the long-term returns of the biggest indices, which cover either the world, which means a global index, or the US market, which is a very big portion of the world, both deliver something in that area. In the case of the S&P 500, it's even higher than 10%, but both of them are even above 10% per year. And I think what that tells us is that buying the market is not a compromise. It's not something we do because we cannot do better. We want to do it because it's the best thing we can do. Because if no one can beat the market, why should we pay someone to try on our behalf and with our money? Look at the returns the biggest indices are generating. And over time, we're not looking at just one specific year or an extremely successful period, but rather over a very, very long period of time. They do deliver very, very, very good results, even above those 10%, which we mentioned before. And so the conclusion is letting our investment run on autopilot, as I call it, will not just save us a lot of hassle, a lot of energy, a lot of time, not to mention a lot of stress. It will also generate the best possible results for us. I think this is the most important thing. And this is really the one place which I can think of that really, really, really literally less is more. The less you do, the less you fuss around with it, the less you try to be smarter than everybody else, faster, more active. No, be lazy, be passive. Just stick to your investment plan, the better your results will be. And I think we have some very strong evidence to show that with all this research that looked into active versus passive investment. And at this point, I hope that it all comes together with, I think, the basic motivation to invest and why it is important for all of us. Why stocks are the best place to put your money in. Definitely in the beginning, where you might not have a large initial amount, but also for the long term. It's not just, again, it's not a compromise because you don't have enough own capital to go into real estate or anything like that. It's a very good place to start and stay and invest for the long term. Again, for pretty much all of us. And if you choose to do that, why the best thing you can do is to act in a passive way and to invest your money in a passive way and not trying to outsmart or outrun anyone else, but simply riding the market as it's going up gradually over a long period of times. Hopefully, it all comes together into a clear as picture as possible. However, some of you at this point might be asking themselves, okay, but what about Jane from the beginning? You remember that Jane, by saving, could save up during those 3 decades almost €500,000. However, if we change this and we stop talking about saving and we start talking about investing, the beauty of it is that without making changes to her current lifestyle and to her current level of spending, if she takes those 20% that she's already saving, but she starts investing them already now, and even without having an initial amount, just from today forward, she will be able to close the gap. It will be enough, and probably even more than that. And again, if we remind ourselves that we were looking at the almost €500,000 that she saved, those are the same €500,000 that you see here. The blue part of the chart is the deposits that she made, the savings, the amount that she saved on a monthly basis and deposited into her investment portfolio. But since it is invested and it's generating return, at some point, somewhere around here, her portfolio actually has more profit, which was generated, than deposits that she made. And this becomes even more apparent here. And the beauty of it is that it grows to such a significant amount that by the time she reaches retirement age, she can actually start making regular withdrawals, taking out money from this portfolio, using this money to complement her state pension. And if she does so in the right way, the withdrawals on the one hand are enough to maintain her standard of living, the one she had before when she was still working. But at the same time, even while she's making withdrawals, her portfolio is still generating returns. And it is very likely in this scenario that she can adjust her withdrawals in such a way that her portfolio will not only maintain its value, but even increase in value, basically letting it increase into infinity. And that I think brings a lot of peace of mind because she doesn't have to worry about running out of money. It's not a fixed amount that she saved and she's now just taking parts of it, knowing that it will last for 10 years, as we showed before. This is now something that keeps on working for her, even while she's making withdrawals. And she doesn't have to worry anymore about this obviously very bad possibility of literally running out of money. How do you get started with something like that? I'd like to present two, I would say, main options. Obviously, there's much more and it's individual and you can all make your own way. But in broad terms, the first option is just start independently. If you have enough motivation and you have the patience, read, watch some videos, do your own research, gather up enough knowledge, open a trading account, which is really, really, really easier than ever before in any one of those platforms or in another one, which is well reputed and highly recommended, and there's really plenty. And once you're set up and good to go, there's nothing more you need to do. You buy ETFs and you wait, and you buy them on a regular basis, on a monthly basis, quarterly, semi-annually, doesn't matter, even annually. And you buy and you hold it for the long term. And that is really the only thing you need to do, and this will serve you very, very, very well in the long term. However, if you're in a position where after today, or even before maybe, you already had it in mind, you know you should, but you need maybe a push in the right direction, or you need someone to guide you a little bit, at least in the first steps. One thing I do offer is investment foundations course. It's in a way a very extended version of the very brief presentation we went through today, where I get much more into details around some of the things we talked about today and some things that we haven't covered yet. For example, the benefits of long-term investing, handling market volatility, questions around timing, explaining the difference between stocks and ETFs and what is probably a better alternative for most of us, but how to manage both. If you are ready to start, how to get started. If you do have an available amount, do you just throw it all in at once? Or do you do it gradually? Supporting you in setting up your trading account to make sure that you got all the boxes checked, that you know how to set it up in the right way. It's really not rocket science, but whatever help you need. We dive much deeper into indices, how they work in the background, how does that thing really help us, and why is it such a good option to rely on? And at the end, my absolute main goal for that is that by the end, you have your own portfolio and you have a plan and you know exactly what you're going to do potentially for the next 10, 20, 30 years without making any further changes. And it's made out of 4 group sessions. It's generally an online course, but it's live. It's not recorded or anything like that, where we go through the sessions as a group. And on top of that, there's one individual session to either answer any very specific and individual questions, but mainly to support you when it really comes to setting up your account and then making the first purchases together so you're really confident you're doing the right thing. Alternatively, I do offer also individual consulting for singles or pairs or families or whatever, in which, depending on your needs, it might be a slightly different process where we first generate a snapshot of your status quo, your current level of income and expenses, whatever available capital you have as a starting point. What are your specific goals and wishes? And also based on your information, as we did today with this hypothetical Jane Doe, what is your projected pension allowance here in Germany according to the system as it works today? We talk also about setting up an emergency fund for any extreme cases, how to manage short and midterm goals if stock investment is not the right way for it, because the market is volatile in the short and medium term, how to integrate into this long-term plan any big changes or goals. Typically, it's often around real estate purchases, and the final product is really a long-term plan tailor-made for you. I would like to add another motivational boost specifically for this audience. Statistically speaking, and generally speaking, women simply make better investors. I think this shouldn't come as a surprise when you think about it for a second, because men are typically, and I'm generalizing here, of course, um, less patient, probably in most cases more ego-driven. They are more um, motivated to show everybody else how successful they are and how they were able to outsmart and outperform the market. Whereas women are more patient, probably ego plays less of a part. And at the end of the day, this is also what the data shows and what all the long-term statistics really show. So, assuming we do have a very strong female majority here in today's audience, take that as another motivational boost, as another push in the right direction. There's absolutely no reason why you shouldn't be successful. Lastly, one more quote from the same guy we saw before, the famous Jack Bogle. The historical data supports one conclusion with unusual force. To invest with success, you must be a long-term investor. And please, please, please keep it in mind. Whatever you do, whatever strategy you choose, whatever your individual plan is or will be, and however you choose to go about it, independently with anyone else's support, think long term, plan for the long term. Don't look for any short term gains. Don't look for how to finance your next big vacation through successful investments. Think about the long term. Think about your retirement. Think about your long term goals. Think about starting investing for your kids if you have ones, etc., etc. Look far ahead into the future. It removes a lot of stress, it removes a lot of noise, and you really will be setting your sights on the right thing. With that, you have my contact details here in case it's relevant for anyone, and we'll now also open the stage for any questions.
There's one first question. Thank you very much, Hagai, first of all. This is all
Okay.
will be recorded for everybody who wants to watch this later. This will be on the YouTube channel. First question is how to do this. Would you prefer to type the questions or to hear them?
Yeah, let's hear them. Will be nice. Or even turn on your video if you want for a second. Will be nice to put a face to the voice.
Hello.
Yes.
Hi. First of all, thank you for the presentation. That was really well made
Thank
and
you.
anxiety reducing, I would say. I'm kind of curious. A lot of my friends are sort of in between on investing in stock market, but also in crypto or in housing. And I quickly looked on the 3-year-old presentation in the VTM. It was about investing in real estate and like buying property, right? So not going to a trade app and investing in stocks, but actually rather buying an actual apartment or house. Did any of that changed in the 3 years? Is there something like a rule of thumb guidance how to like split our investments in like different in these three directions, or just the S&P 500 is still better in the long term?
Okay.
Not too much.
No, it's all good. I will try to answer all of it.
Okay.
I would say this. I mentioned it here probably quite briefly in one of the slides. I do strongly believe that investing in the stock market is where you should start. Um, let's maybe even give another example. If
Mm,
someone were to say, I do have exactly enough to put down as own capital for a real estate investment,
mm,
but after that, I am not really liquid anymore, with or without having an emergency fund still available. But even with it, it's fine. But when you think about it purely rationally, that's not the ideal situation to be in. Because one of the things we're looking to achieve with specifically with index investing is diversification and not to be fully dependent on one company or even one market.
mm.
By investing a lot of your available capital into a real estate investment, you are everything but diversified. Everything depends on that specific investment. And I think also from having a lot of conversations with people who asked a similar question where we maybe had even longer to discuss, real estate is very, very specific. Every single investment is very specific and very individual. It's much harder to make general rules with regards to real estate. Whereas with uh, index investing for the long term, there's really not too much you can do wrong.
Thank you. And is there such a thing as index for cryptos separately, or there is no such thing at all?
Yes, there are today already ETFs that would track either
That's
specifically Bitcoin or a larger crypto portfolio. Um, this is not entirely comparable with
mm.
directly buying the crypto, but it's absolutely not a bad way to start. I mean, it's a nice way to spice up your portfolio with a little bit of crypto. But
Okay.
again, I mean, even looking at the last few days with Trump launching his own meme coin, I would advise caution when it comes to crypto. And I think it's fine nowadays to have it as another portion of your overall portfolio, but it should have the right proportions.
Yep. Okay. And that's probably, I guess, person to person rather dependent.
Yeah, I wouldn't. I mean, it's a very individual decision how high the portion should be, but be cautious.
Okay. Thank you.
You're very welcome. Hila raised her hand.
Yes. Hi.
Hi.
I wanted to ask, how can you know, or you are basing your entire assumption on making at least 10% yield per year. And I wanted to know, one, how can you guarantee that will be the case with even a solid investment? And two, I'm not sure what you meant by brokers when you started your presentation, but did you mean something like BlackRock, for example? And if so, now that BlackRock also offer S&Ps, doesn't that necessarily mean that S&Ps could lower their yield in the long run?
Mm, okay. Let's start with the first part. So, at the end, and it's again it's a very important observation. When we look back, we do see how those main indices, such as the S&P 500, which basically represents the biggest companies in the American market, or the MSCI World, which covers the biggest companies globally in the whole world, or at least in the developed world, we do see how those indices generate historically 10% or even slightly higher than that over time. That being said, two main points. A, there is no guarantee. Never. Not with regards to those indices and not with regards to the performance of any other financial instrument, apart from, of course, the fixed interest instruments. I mean, if you put your money in Festgeld, which generates 1 or 2%, then you will get your 1 or 2% in all normal scenarios. At the same time, I would add that when I prepare for someone the long-term plans which I mentioned, I never, ever, ever calculate 10% in. Never. Because if you sit down and go through this extremely important process of looking at your personal finance now, but you are looking far ahead into the future, 20, 30, 40 years, and you assume the best case, and that's not reality, then you might be in a very difficult position in 20 years from now. And so I'm always much, much, much more conservative, much more cautious, and I would much rather reality to surprise us for the better and not the other way around. So that's for the first part of your question. The second part, I'm not sure I fully got it. Did you mean the part where I mentioned setting up your own trading account at an online broker?
No, you were talking about how brokers cannot predict the market, and or was it?
Okay, you mean the active fund management.
Exactly. I wasn't sure what you meant by it. Would you consider something like BlackRock such a company that manages your assets in that sense? And if so, now that they offer S&Ps as a package, they guarantee that it won't fall. They guarantee they insure your S&P purchase, basically. This kind of tells me that S&Ps are going to have less of a profit if more people invest in them, if this is more of let's say, government funded or government backed type of institution and not free trading as it was until this point.
If I got what you mean, and I hope I did, then that's not exactly the case. BlackRock being a very, very, very large company, offer many types of different products to different types of investors, probably mainly differentiated by the size of their portfolio or the amount of available capital they have to invest. And they do obviously, I mean, at the higher end, there will be investment products or financial products that are tailored for high net worth individuals. I'm leaving that aside. That's not necessarily relevant for our discussion now. And what we care about more probably is the ETFs for the sake of our discussion that are provided by BlackRock. And they are definitely one of the biggest providers. And they also, not that there's too much to do, but they do so very well. I mean, with quite low ongoing costs and definitely a wide selection of ETFs. The last part of what you mentioned with how would that somehow indirectly make the S&P less attractive or would cause the performance of the S&P to be not as good as in the past. Here I'm missing something, and I think, I mean, we could either take it offline or cover it in a different way, but I think maybe a deeper dive into what are indices and how they work could explain it. But to maybe go around it
If
a
I
little
can jump in quickly, I think I can bridge that if I understood what the question is. You are indeed answering a different question. What I think Eli was asking is a little bit confusing managed funds with BlackRock. BlackRock does not do managed funds. Managed funds is a company that you give that takes money from many people and invests that in things like products that are offered by BlackRock. Ila, did you assume, did I understand correctly that you assume that BlackRock is a management fund, which is what Khagai mentioned in the beginning?
No, what I was referring to was more like if as an I mean, we don't have to talk about it right now. I think it's a very specific question, and I'm not. What I was generally asking was more to understand if S&P possibly in the near future are going to yield less than 10% as a even as a cautious estimation, because they are becoming more popular and let's say have more of a let's say governmental even, or like what the word, I'm lacking the words right now, but more of a like are backed up by big concerns and not just private investors anymore. What my main question was whether S&P or when or if S&Ps yield less than 10%, how will that affect those estimations? Is there something else that you would think is a better investment, or how to protect the money to really make at least yield at least 10% each year? That was the general question, and I just focused it on something that's conservative like S&Ps to understand if that can ever happen. In 50 years, S&Ps are not longer that reliable, trusty fund that we thought it was.
I think the important part is to maybe simplify it even further and to say that at the end of the day, as an investor, it doesn't matter if you're a small private investor or a bigger one, if you buy an ETF that tracks the S&P 500 index, what you are saying in financial terms is that you believe the American market will deliver superior performance to the global stock market in the foreseeable future, which on the basis of the past 2 decades is a very reasonable assumption, but there is no guarantee that it will stay that way. Personally, I do believe that if you truly accept and believe that nobody knows anything, if you truly accept that there is no way to predict which will be the most successful companies, the most successful markets, the most successful segments, then the purest form to execute this strategy would be to focus on global indices rather than the American one. Which in that case, again, you have many very good options. You have several different versions of the MSCI world. You have the FTSE developed world or the FTSE all world. You have several indices that do cover the global stock market. And because of the very nature in which indices work, it puts you in a good position to, again, passively, without taking any action, to be ready, so to speak, for a world where the US is not the best performing market and other markets are overtaking it in short and midterm performance or even really in absolute size. I do not know, and I cannot predict it, obviously, but just as an example, if you have concerns about the American market, or you have a very strong feeling that the up-and-coming countries will overtake the US at some point, buy the global index, buy the global market. You're not making any bets at all. You're not making any assumptions as to what would be the best investment. You're buying the whole thing. I hope that answered it. Anna wrote on the chat, "Hi, buying ETF on trade platforms are connected of some noticeable fees. Did you take into account in your calculations?" Generally speaking, yes, absolutely. I'm being much, again, when I do make detailed calculations, even today in our example with the famous Jane Doe, but definitely when I do make such calculations and plans for specific people, I'm actually being much, much, much more conservative than just considering the fees. However, that said, there are quite a few very, very cheap options today that charge very, very low fees. The ongoing management fees, the so-called total expense ratio of ETFs, is so low that it's probably negligible. We're talking about 1.15% or 1.2%, something like that. Sorry, that's important, 0.115% or 0.2%. In some exotic cases where the ETF is tracking something that is slightly more complex, it might go up to 0.3 or 0.4. It is still very, very low. And the fee for buying units from that ETF, basically the fee on the actual order amount is also quite low in at least most of the more modern and attractive platforms. It will be definitely more expensive if you do that through your bank, assuming it's a traditional bank. But the neobanks or the platforms like Trade Republic, Scalable Capital, etc., they are really, really cheap in that sense.
Thank you.
Can you send a link for your course? Is the info on the left side? Yeah, definitely. Just go on my website. You have the link here, or you can send me an email to the email address that is shown here, and you have all the details there. We can also have a chat before to see that it's really what you're looking for, and yeah, absolutely. Is it even possible to lose money with some top X worldwide index? Yes, it is always possible to lose money. Actually, it's even quite easy. No, but jokes aside, yes, it's always possible. However, that depends mainly on your so-called investment horizon, meaning for how long you're investing your money. With all the necessary disclaimers that we can only look back and learn from history, we cannot fully predict the future. If we do look at historic data, the longer your investment horizon is, the higher the chances that you will make a profit. And generally speaking, there is something that I'm personally a really big believer in. In the long term, there's really here a reversion to the mean. And the longer you invest for, the higher the chances are that you will end up making those average long-term returns of around 10%. And statistically and historically speaking, from everything we know of stock market investing to date, if you invest your money for at least 21 point something years, the chances of losing money go down to zero, effectively to zero. And you are in the probability that you will end up generating the average long-term returns is over 90%. So the biggest factor, as I mentioned before, is time. Time is your biggest friend, and the sooner you start and the longer you stay in, the better your chances are.
Well, I guess no more questions. And in case anybody does have questions, we do have your email. So, on behalf of everyone, I would like to say thanks again so much for the time, and thanks everybody for joining. And hope this year you'll start investing. This will be available on our YouTube this week. Thanks, everyone. Have a great evening.
Thank you very much. Bye bye.
Bye bye.